Our tax bracket system is what we call progressive. That means progressively, as you make more money, not only do you pay more in taxes, but the percentage that's applied to your income goes up. Hi, friends. This is Colin Richards, and welcome back to this segment and episode of the Lord and Richard Show. And in our prior segment, we talked about the critical importance of acting now to develop a plan to reduce your taxes. Don't coast. Don't go with the flow. Don't go down the lazy river of life and fail to put measures in place that could keep you from spending thousands, if not tens of thousands more in taxes than you should really be paying. And that would be really, I think, a crime. As a steward of the resources that God entrusts to us, it is vital that we act as a good and faithful steward over those resources, not just because it's in our own best interest, but because we've been entrusted certain things by God to use for His kingdom and glory. And so in this segment, we're going to dig in a little bit and talk about how our tax system currently works. As I mentioned in our previous episode, we are in an historically low tax rate environment. We should be taking advantage of that, and we need to understand how it works. Now, as I've told you, you don't have to do this heavy lifting. You don't have to memorize what I'm about to tell you. You just need to know that at Lord and Richards, we're on top of this. We are experts not only in tax preparation, but in advanced tax planning. We can even get you involved at ultra high net worth levels with our ultra experts, tax attorneys, and so forth to help make sure you don't pay in excess of what you should pay in taxes. So let's start with a very simple understanding of our taxes. And I always have a choice as to whether I'm talking about taxes for single people or for married. Well, I'm going to use illustrations for married, but we simply adjust the numbers. The same rules apply. We just simply adjust the numbers if you're single, okay? But as we think about it, the most basic understanding of taxes is that the government wants a percentage of your income, right? Now, it gets complicated after that, but at this stage, it's pretty simple. For example, right now, if you were to have income below $23,850 as a couple, you would pay no taxes. And that's designed to provide relief to the poor in our society. Our tax bracket system is what we call progressive. That means progressively, as you make more money, not only do you pay more in taxes, but the percentage that's applied to your income goes up. So once we get past $23,850, now we're taxed from 0 up to $23,850, we're taxed at 10%, not 0%, But then from $23,850 and up, we're taxed at 12%. Now, bear in mind, at that lowest bracket, the reason I said you're not really taxed is because your deductions will eliminate all of the taxes, your deductions and credit in that 0 to $23,850 income range. So for an effective tax rate, not a marginal rate, which is the bracket, but an effective rate, you would be paying 0. But then you can make almost $100,000, a little over $96,000 as a couple, and stay in what we call the 12% rate. These rates are really great. Then we have a jump up. So we got 7 of these brackets. The first 2, there's kind of a big jump up from 0 to $23,850 to get to 10%. But then we have a big bump up to get to 22%. And at 22%, you're going to discover that you have the flexibility to earn up to $206,700 as a couple. That's pretty generous. And most of the people that you're going to bump into every day are going to fit into those first 2 or 3 brackets, okay? After that, we move into the 24, the 32, the 35, and the 37% bracket for those who make north of $751,600. So we have a 7 bracket system, or what some people might call 7 buckets, but I like to call them 7 brackets. And what happens is the first few dollars that you make are taxed at the lowest bracket. and then the next few dollars are taxed at the next bracket up, and so forth. So your average across all those brackets is what we call your effective rate. So if you had a little bit of money taxed at 10% and a little bit of money taxed at 12%, your average would be somewhere between 10 and 12. I hope that makes sense. So this is the simple, easy part. And if you just fill out good old Form 1040, it's pretty simple. But as we move forward, I want you to understand that there's more to meet the eye, more than meets the eye. Because as I said earlier, there are additional deductions. For example, as a couple, I'm using a couple, but this would also apply to singles, just different numbers. You got a deduction that covers $26,600 of your first income. So your real tax rate, even though that first bracket is 10%, is zero up to that point. So only the income that falls into those brackets gets taxed, the real income after your deductions, okay? So now let's move kind of to the next level. Let's discuss these marginal tax rates. So your marginal rate is the last bracket that you fall into. So if you got a little bit of money at 10%, a little at 12, a little at 22, and that's it, your top marginal tax bracket is 22. All right. It works similarly with investments. So let's talk about that. Moving out of your income, you can invest money, and that money can potentially grow over time. We call that a capital gain. If that occurs outside of an IRA or 401k, that's income that is gained on your investments. And you know what? Our Congress created a system, designed a system so that you would be encouraged to invest, to give you basically lower rates. So in those first couple of brackets, if you fall into the 10 and 12% bracket, you're going to pay no tax on your gains. So for the average American who's investing, depending on the amount of your gain, you'll likely pay not very much. Now, then we move a big group of people into 15% taxes on long-term capital gains. This means investments you've held for at least a year before you sold them. And so that's a preferred rate. It really is, because if you're making north of $100,000, you're in a preferred rate all the way up to $600,050 of 15%. That's great. That's great. It encourages investing. It's not a tax loophole for the rich. All of us can invest. All of us can take advantage of that. So it was designed on purpose. And then once we get really high on our income, $600,050 north of that, we're going to pay 20% on that money. So you're going to pay 0 to 15% on the first $600,000 based on your income, and then 20% north of that. And again, if your income is $600,000, now that includes your ordinary income plus the gain on your investment when calculating that bracket. So pretty cool. I like capital gains tax rates because they're generally lower for most people. So we're going to come back with a little bit more information in our next segment about qualified dividends, capital gains, and other forms of taxes that we just need to be aware of so that we can start moving our money from forever tax to never again tax. That's the principle I teach at Lord & Richards ad infinitum, ad nauseum, is move your money from your left pocket, which is taxable money, to your right pocket, which is tax-free. And in between, we have money that's taxed at a lower rate, like capital gains that are long-term. But in the meantime, I don't want you to memorize all this. You don't have to remember it. What you need to know is your team and at Lord & Richards, we've got you. We've got this. We're helping clients just like you to save potentially hundreds of thousands of dollars. This year, we had one client we helped save about $700,000 in taxes. That's extraordinary. But whether it's $7,000 or $700,000, we don't want you to pay a dime more than you should be paying. It starts with a simple call to get your tax reduction plan in place. Just pick up the phone and give us a call at 720-372-0400. Again, that's 720-372-0400.